Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Jason Perro. Jason started his real estate investing career in 2001 with a duplex, left his full-time job in 2012, and currently owns around 1,300 apartments. So thank you so much for being on, Jason.
Thanks for having me, Charles. I'm happy to be here. Good to see you.
Yes, good to see you too. We've met a number of times in face-to-face at different conferences, which we haven't been doing for the last year or so. But
I know, soon enough. Hopefully soon enough.
So what was your background prior to starting to invest in real estate?
Well, prior to investing in real estate, I was just a few years out of college. So I graduated college in 1999. Met my wife like very early part of 2000. Well, at the time we were just dating, early part of 2000, but we were just starting out, didn't have really anything and had this goal of getting rich. I guess at the time that was, for lack of a better word, just, I didn't grow up around money, didn't have a lot of money. We weren't poor, but just I had no idea about building wealth and really, real estate seemed to, fill that need. That time read Rich Dad Poor Dad, 90% of other people in the business. But I said, wow, this is the vehicle, this is the key. And at the time, I just thought, hey, if I buy a property or two a year for a number of years, I'll, be able to retire and do that, and just that alone. But of course, our tastes and things evolve, and wanted to do more and be more. But I worked in sales, so I worked a few years in pharmaceutical sales, and then did medical device sales for about 10 years. And it was a huge learning experience, just having that corporate life, that pressure. But all the money we made, so my wife worked in pharmaceutical sales as well. She was able to leave her day job in 2010, but those early years, we did it the old fashioned way. We just pummeled like one person's salary into buying real estate, knew nothing about private money, knew nothing about syndicating, knew nothing about, larger properties, just kind of grinded it out for a bunch of years. And that's just how we got our start. We just sacrificed, lived way below our means, and just tried to do everything we could to try and start building this little real estate business.
So your first couple investments, your first one was a duplex. What happened? What went wrong? What went right? How'd you acquire it?
Yeah, well, a lot went right. I mean, it was, we bought this duplex for 32 grand. And so it closed on it about a week before 9/11. It was like the first $3,200. It was like a 10% down payment. Just got like a regular bank loan on it. It wasn't, you can judge by the price. It wasn't great. It was in a decent area, but it was older, and the rents were really low. They were like $325 a month. But went in right away. Now this is 20 years ago, but we went in right away, raised the rents, and I think maybe raised them up to like $475. And then over time, then until this past year, they were up at like $550. And so a lot went right. It was just a duplex. We'd have a long-term tenant. They pay their bills. Things break, we fix them. But over the years, we did minor upgrades, like replace the windows and replace the roof. And then unfortunately this past spring, like right around Memorial Day time, had a fire in the upstairs. So the upstairs was actually, both units were vacant. And they think maybe somebody broke in, and caused the fire. Wasn't totally devastating, but I'm like, oh my gosh, like, do we want to go in and like fix this up? And it's kind of at this crossroads, but I ended up selling that on land contract to one of my old property managers, who's now a real estate investor. And so I'll continue to make cash flow on that property for another 15, 20 years. So that was like a great starting point. The property had kind of held a special place in our heart. And it was just, eventually, you kind of graduate into different properties, but that was the launching pad. Then, we bought it from the time we started to invest in real estate, was looking for mentors, looking for people that, we could buy property from. And this was a kind of a friend of the family. Guy was a retired IRS agent, and he was partners with his brother-in-law, who was a school teacher, and they had maybe, 35, 40 units at their peak. And so the next year, I said, hey, I'm ready to buy more property. And they said, okay, well, we have a duplex and a 4 unit. And I bought those. And then the next year I'm like, hey, I'm ready to buy another property. And, I bought a 7 unit from them, and ultimately bought a handful of property from them. But it was all a positive experience. Early on, we didn't know any better than just, buying properties. And then as we started having children, and the demands of our day jobs got to be more like, oh, wow, we've got to think about, adding infrastructure. And part of the growth pattern was like, we have to grow or we're just going to implode on ourselves. So I'm not handy, but I used to paint. I used to throw a lawnmower in the back of my car and do that type of thing. It's a good learning experience. I mean, you don't have to do that. You always have a better, higher and better use of your time, but taught me lots of ins and outs of like how to change locks on apartments, how to do stupid little repairs. I'm not really any good at it, but it was something I learned I didn't want to do. I didn't want to be that landlord that I'm just tinkering around with my rental properties all day long. So, 4 years in the business, then I got my first real mentor in the business, and met this guy, and he had, a bunch of property that he was willing to sell. Said, hey, if you come up with a down payment, I'll own or finance the rest. And from that point on, that helped us leapfrog into bigger and better things.
Nice.
Yeah.
Yeah, that's awesome. That's a great place. Yeah, I did the same thing on my self-managed for years, doing all that, rebuilding the toilet kits and changing locks. And I'd have bags of different locks from different apartments that I was switching between it, and keys going everywhere. It's funny because my dad did a lot of property, he managed his own properties, but he had a team doing it. I never saw my dad changing locks, and he had a system, and I was like, but years into it, then I was like, oh, I can just hire someone to do this landscaping and this kind of stuff. And it made it so much easier. So, but you don't know that right from the beginning, or you're trying to, you're learning the business secret, like you said, but you also don't know that you're able to easily just how easy it is to outsource stuff. You know what I mean?
Nobody teaches you the stuff like
No.
growing up, but that's
No.
that's okay. You have to learn it. And the faster you can learn how to get things in a system and hire people and outsource stuff, if growth is your goal, then you can grow easier.
So you own several hundred units now yourself, and now you syndicate. So what is your current acquisition criteria?
Yeah. I mean, the simplest thing is the deal has to make sense. If I'm going to syndicate, I'm looking for the ability to pay out my investors at what they would expect or think is a good deal. So maybe 8% cash on cash, 15 to 20% IRR. What I look for is that worst case scenario that, hey, day one, the deal can make, it can make money. I wouldn't want to be the guy or gal, stuck mid value add when the COVID crisis hits and you're trying to, push rents by $300-400 a month. I love a value add play. I mean, there's a ton of wealth can be created that way, but I look for a deal that can hold its own day one, but then has enough upside to make sense. I really like, most of my property honestly is in my backyard, Erie, PA, Northwestern Pennsylvania. We're in Cleveland, Ohio now, getting ready to close a deal in Texas, have something going on in Florida. But at the end of the day, I like these secondary and tertiary markets because as we've all seen recently with COVID, but back when the 2008 Great Recession happened, and even around 9/11, when the economy takes a hit, these secondary and tertiary markets aren't as impacted. They may, rents may take a little bit longer to increase, but we're not seeing like, right now, I'd hate to be a landlord in San Francisco or really, anywhere in California or somewhere where rent prices are really high. So I just like to look for areas that will withstand an economic downturn. So Cleveland, Ohio, where we're investing as well, I love that city, but when there's a big, the Great Recession hits, they might be affected, but people still need a place to rent, and the rent values aren't so high that people aren't going to pay those. So I think your multifamily investment should be able to weather any kind of storm that comes to it.
Yeah, for sure. Has your criteria or strategy changed during COVID at all? Or are you just more conservative?
I I would say I was generally like, I'm aggressively conservative, and I don't know if that makes any sense, but I mean, I try to, like, when we underwrite a deal, I want to really look, I'm looking at two sort of models, right? I want to look at, hey, pie in the sky, if everything hits, and this is true for our syndicated deals and just what we own ourselves, but hey, if everything hits, this thing's just a grand slam all the way around. But look, conservatively, hey, if rent increases don't meet our expectations, or CapEx is higher than we want, can this deal still make sense? So we always try to stress test, and that's something I've done for a very long time. So the criteria hasn't changed much, but what has changed is, though, if we're going with agency debt, by and large, we're stuck with these crazy COVID reserves. What do we do with those, right? Does that become something that when those are released back to us, can we implement a nice CapEx plan to, start, maybe increase the value and get some better rents? So that has changed a little bit, because we know we're going to have to, the lender's going to hold, several $100,000 in many cases of our money. So what do we do with that, right? Or do we give that back to investors when the funds are released? So I guess from the way we analyze it, maybe create a business plan. But at the end of the day, I think for me, the fundamentals have to be the same. I want something that, that over, say, a 8, 10, 12-year period, we can deliver, 8% plus cash on cash returns, plus, really have that 15, 20% IRR.
Right. Yeah, for sure. So, but we spoke prior about about your management company and your 600 plus units that you have yourself. So you self manage that, and are you able to give us an overview of the property management arm of your business, how you run it?
Sure. And we're vertically integrated on the syndication stuff as well. So we manage all those units that are in Northwestern Pennsylvania and Northeast Ohio. So Cleveland area, everything's in house. Yeah, I mean, I'll tell you, it's a lot easier to acquire properties than it is to find employees. Or that was the truth for a lot of years. So I think what really helped us was when we learned how to actually build a system and create, try to really create a company culture that, we're attracting top talent on all ends, whether it's office staff or, maintenance staff that's out in the field. And, we have a system in terms of how we list the units, and how we rent the units, and leasing, and lease renewals, and how we handle maintenance calls. But a lot of it's been trial and error. A lot of it's been, figured out through best practices and masterminds, and seeing what works and what doesn't work. At the end of the day, I mean, the good and the bad with that is that, if you have a property management company and you're actively involved, somehow, some way, tenants may be able to find you, unless you just have, I have a few dozen employees at this point, but inevitably I'm always able to be found somehow. and that's okay though. I mean, when my wife and I started our business, we wanted, we took a lot of pride in it, and we still take a lot of pride in the business. So, the highest and best use of my time is not talking with tenants about, a maintenance issue or a lease renewal concern. But you know what, if that's what it takes to get the job done, then, you have to make yourself involved. And so that can be a burden. It can be, it's not necessarily a waste of time, but it can be a time drainer. So that's the downside of it. But I've, and it's really trite. I mean, people say it all the time, but if you can find people that are better at certain things than you are, find people that are better at saying no to that applicant that shows up with all the money in hand, they're ready to move in today. We all know that's probably the wrong person to take, that you need to follow your criteria on who rents your apartments. But, when you're the one handling it, and it's your baby, that apartment complex is your baby, you might be more inclined to let that person in and listen to their sob story, rather than look at the cold hard facts and say, why would I want this person? They don't meet the income requirements. They've had recent evictions or whatever the case is. So, you want people that can say no. You want people that can follow your criteria for what you want in terms of, tenant base, how you want to respond to maintenance calls, that type of thing. So, and honestly, like, there's people that are built for that type of thing. I mean, we have an employee who used to be a caseworker. She loves like dealing with drama and setting people straight. Like, she's like, oh, you're not going to pay your rent because of an eviction moratorium. Let me teach you why you are going to pay your rent. But that's like, she loves that. And I don't like those conversations, not in the least. So I think that, there's a lot of different personality types that are built for different parts of this business. So, and I'm still learning this, but the quicker you can recognize that, hey, you know what, there's going to be people better than you at a lot of these things, get out of the way and let them do their job, kind of check your, and it's all your own ego, it's all what you have in your head, get out of your own way. And boy, you can really go far with getting the right people on board.
Yeah. And make sure those right people are proactive so
Yeah.
that you're not having any issues of bottleneck, right? And turn into something that they shouldn't have turned into. But so what is your current role in your business, and what does your average day look like for you, since you're kind of more sounds like on the acquisition and I guess present side of the property management company?
Yeah. Well, I think it's really, like acting as a CEO or president of a company, right? And that oftentimes is the vision setter, setting the pace, setting the tone for the company. So constantly working on the business rather than in the business. And for years there was this transition of like, yeah, I'm doing both, but so stepping out of the way to let people do their jobs. But I'm measuring metrics, I'm analyzing data, making big decisions and letting everybody else make the little decisions, right? Like, hey, telling our employees, hey, this is what we want, this is our agenda. Now you can make those decisions, you can make things happen so we can meet our goals as a company. So it's really trying to set that pace and set that course. So and a lot of that is being the vision of what do we want our company to look like, what do we want our employees and tenants experiences to look like, and then hiring people to make sure that those goals are being met and making sure that everybody's in alignment with those. That's really hard, right? To have everybody swimming in the right, in the same direction. But really am involved in the acquisition side. I mean, I like that. That's what we do. But even on that side, having people that maybe are really good at, crossing T's and dotting I's and making sure that every element of a deal is underwritten properly. So again, like, I'm really good at with our relationships with our brokers and off market ways of coming across deals, really good at uncovering opportunities, but having people that in place that can really scrub that and make sure it's the right, the right fit. But as we buy, we're selling. So, kind of churning the bottom part of the portfolio, maybe things we've owned for 15, 20 years and have a bunch of equity in. It's time to kind of let those properties go on to something else. And so we've owner financed a lot. We've sold things and just taken the equity and trying to move it in a different direction. So actively involved in that part of it too, to kind of get the business to the next step.
So what is your role in the acquisition? Do you focus more on, say we're doing syndication deals, are you sourcing deals? Is that like your thing? Are you underwriting deals? Are you raising money? Are you doing a little bit of each? Or are you kind of even more higher level than that? And you might have a couple people that are doing that for you, and you're coming in and, yes or no on a deal and stuff like that.
Well, so yeah, I mean, the truth is I'm still doing a little bit of everything like that. So even with our syndication business, I am at the high level of it, and I sponsor the deal. We pledge our balance sheet, I sponsor my own deals and sponsored other people's deals as well. But as an example, I mean, a deal comes along, it makes sense. Maybe I want to syndicate it. I'll make a phone call or two to say, hey, I'd like this partner or that partner on a deal. Let's put a team together and make the deal happen. So I have a good friend of mine in the business. He's popped on a couple of our deals, and there was a opportunity that had arisen from a seller that we've bought in multiple properties from. And I said to him, I said, look, we're going to have this opportunity. I'd like to do it 50-50 with you. So let's just, we kind of said, we know we can both do it. I'd say it's smaller. Smaller is relative. It's a $4 million deal. It was about a $1.3 million raise. So we both said, hey, we know we can do these alone. Let's just make sure we have a room for each other in the deal. So we both raised money. But honestly, it wasn't that big of a lift for us. I mean, we kind of just made a few phone calls. each, and then had the money committed because it was a smaller nature of it, and just didn't require a lot of work. I mean, the one thing I think a lot of people forget, whether they're self-managing, self-owning a small portfolio or syndicating, is, I didn't get into this to create an 80-hour-a-week job for myself. So sometimes it is like that. And I'm like, all right, I got to, you got to pump the brakes a little bit. And I know you put in the work so you can have the rewards later on, but that doesn't, I didn't get away from corporate life to keep working 80 hours a week. Sometimes you need to, and you have to do whatever it takes. But as we've started to grow and the syndication thing has taken off, I've identified things that, I can do all of that. I mean, I've built my own portfolio by doing all of those things you mentioned: raising capital, underwriting deals, obtaining financing, sourcing the deals. But a lot of that takes a lot of work. So happy to give up some pieces of that, of those duties. Hey, there's some people that can do that better, more efficiently, or that really enjoy that aspect of it. So for me, it's been, just, hey, I can step back a little bit and really, work on more of the higher level stuff, which I still struggle with, because I do like raising money. I do like sourcing deals. I do like doing all of the kind of the nitty gritty. But as we keep growing, I keep, finding ways to give up some of those things that I enjoy doing.
Yeah, it's a great, I did that. We started doing that probably 12, 18 months ago, and just start focusing on certain parts of the acquisition and syndication. And we're like, hey, we like, the co-asset management. We like raising money. We like doing these things, and left it to a couple of our partners for sourcing deals and underwriting it. And they love that the analytical part of it. They love making the relationship with the brokers, which is a full-time job as it is, to do it correctly, right? Especially in the market we're in now, right? Yeah. But speaking of that, so we're in a very competitive market. How has your company changed or implemented any new deal sourcing techniques for finding deals? Like, for example, one of my partners, they brought on a broker pretty much in-house into their company to source deals. So it's like, I'm like, that's outside the box. I love that type of stuff. Have you guys done anything like that, or changed anything around to for your personal portfolio on smaller properties or on syndication? Done anything like that?
Well, so for our personal portfolio and what we own, what is local to us, I haven't had to change much. After 20 years, like, I think when you're starting out in the business, you've got to do a lot of things to set yourself apart. When you've built a reputation, with various brokers in a certain market, you're going to be on the short list of people that get called when an opportunity arises. You might not get called on everything, but even sellers that say, hey, you know what, I'm going to sell, then your name can come up. That's just been years and years of networking, getting to know, most owners in the market. And then, we'll still cold call. I mean, we're running out of opportunity in our backyard. There's just not a lot left that is larger that we would want to acquire. So as we go into new markets, to me, it's really about having that broker relationship, and or being able to source off market deals. The thing with, I've got a strong relationship with a brokerage team that, they find, I mean, not a lot makes it to market. They work with these off market sellers, and, they know what neighborhoods we're looking in, and they're like, all right, here's the opportunity, thumbs up, thumbs down, let us know what you want to do. And it's just become, so I'd say they almost work for us, or we work for them. I mean, same thing, but they, same thing with our lender. I mean, I underwrite a deal, shoot it over to the lender, and they have their analyst. I can't stress enough how important it is to have a good lender that's going to almost be a de facto maybe, you don't want to maybe replace your CFO on your current team, but my lender, my loan broker acts as a CFO. And so, I mean, we talk multiple times a week about deals, and he's kind of the, he's always going to ask the tough questions, and might sometimes tell you what you don't want to hear. But being being a sponsor on some folks' other deals, I've seen what the industry has as a normal loan broker, and a lot of syndicators and non-syndicators, they're just always going to go for the best rate, and always just going to just shop it around, and it's very just transactional. But, I found with my guys, I said, they're getting me the best possible deal. They're giving me various options on every opportunity we're doing, and they ask all the tough questions. And if I'm thinking about the deal in one way and they're thinking about it the same way, I trust that opinion, right? And so, to me, that's just, not I mean, it's not to knock having like 50 broker relationships, but it's better to have like one or two like really good friends, best
Mhm.
friends in the industry that, hey, this broker is going to call me on every deal. And if he puts something to market, it's because you passed on it already. And so to me, it's just really been trying to become even closer and better friends with those guys
Mm.
that we've done multiple deals with,
Yeah.
be it from, private sellers or the broker side. And those conversations are just, it's multiple times a week that we're talking and trying to best strategize on what the next deals look like, the best opportunities to deploy our money.
Yeah, and that's your competitive advantage. You have access to capital and you have the relationships, which, puts you above, 90, 95% of other investors in in the markets that you're looking at. So
Yeah.
that's great. That's awesome. The other thing too is having a good broker that is underwriting your deals pretty much on another level,
Yep.
which is awesome because you send to them, they're like, listen, this isn't gonna pencil. You know what I
Yep.
mean? Or this has to be looked at. And that's awesome. I was told once by a broker that or lender that you think of lenders like restaurants where you're paying for different kind of services kind of a thing. And even if
Mhm.
they're not getting the best one, or if you're paying a little higher on that broker's fee, it's usually really well worth it in the long run because they might be giving you additional service and you're
Oh, yeah.
compensating for their additional experience in their field,
Oh,
right?
yeah. I mean, it's there's a deal I'm working on right now. I'm not going to say where it's at just because I don't want to I don't want to out the loan team, but it's painful. And had this group use my guy, and there's a reason why they went with this particular loan broker. They already knew the property and the market and everything, but man, it's like, um, it's just kind of like minor league compared to, you know, my loan broker. Just nice guys. But they're really just trying to do the best job possible for you as the borrower, and they're really thinking about these, the things that you may not be thinking about, and making sure that you're doing a good deal. When you're buying, you just sometimes you tell yourself these lies that you think a deal is going to be fantastic, and you try to outsmart what the real data, what the metrics are going to be, and you never want to. The truth will always come out, right? So, and sometimes you think you can outsmart or outwork the current management or the current business model, but you know what? Maybe there's a reason why a property works a certain way, and it's just good to have those conversations where there's a reality check, and these guys are really stress testing the deal with you and make sure you're doing the best thing for you and your investors.
Yeah. So, what do you see for the next 12 to 24 months in multifamily? I guess, I mean, with the economy, with everything that's
Yeah.
happening, we're already in COVID for 12 months as we're speaking.
Yeah, I mean, I'm not. I don't have a crystal ball. I mean, I think
Yeah.
that multifamily by and large is still going to be a very strong investment. And I've kind of heard both sides of this
Mhm.
argument. I've heard some people say, "Hey, look, there's going to be a crash. Like all these people have been people have been overpaying for multifamily for a while now. That there's going to be a day of reckoning." Um, but the counter to that point is that, look, interest rates are still really low.
Mhm.
There's investors that are chasing yield, um, that's not that great. So there's some investors that they're happy with 4 or 5% cash on cash, and if that's the case, that can continue to drive prices
Mhm.
in certain markets. Um, but I think that there will be, I mean, you know, whenever there's an economic pullback, I don't know if that's a year from now, 5 years from now,
Yeah.
that could affect how far you can push rents, right? It
Mhm.
may soften it. I mean, people still need places to live, but it's really like, how does that affect your business plan, right? So maybe you had a straight value add strategy and you were in the middle of a bridge loan or a hard money loan. And if you haven't been able to execute your business plan, that might, that may affect your ability to then get the valuation you were looking
Mhm.
for. And you might have some
Yeah.
disappointed investors, or you may lose the deal completely. But I think by and large, the fundamentals are still very strong. But no one really saw COVID coming, and And then when it came, everybody was panicking, thinking that, nobody was going to pay rent. And, I think there's certain markets that's true, but I don't know. It seems like multifamily still, it keeps going up and up. I mean, it's trading like crazy. So, I honestly don't know. What I do know is I'm just going to continue to adapt to whatever's out there in the market. I'll just adapt my strategy to meet what the market has at the time.
Yeah, I agree with you. It's like, I think the value add, it's a great strategy. And I think it's pushed by a lot of gurus but it's something that I believe is not something that you can utilize in every part of the market cycle. I mean, you're not people are telling me they're doing value adds in 2020. And I'm like, I'm not kicking out anyone that's paying me rent.
That's right.
I mean, and you would be very foolish to do that. Have a call with your investor base and tell them, but it's like, I'm not going to kick someone out, try to put $5,000 or $2,500 into a unit and try to get out another $125.
Right.
That's when you push it back, and you're taking care of a lot of your, take care of your roof, take care of some mechanicals, take care of stuff like that. But stuff we're doing now, we're not penciling in rent increases for a year, maybe even more. Well, and it's like, we're cleaning, painting, and renting.
Well, that's a great point. I guess one of the things, the way we underwrite our deals is, we'll usually take 2 to 3 years to see if we are anticipating rent increases.
Yeah.
We'll make sure we're taking 2 to 3 years to realize that. And this portfolio I'm buying right now, it's smaller. It's 35 townhomes, but the average rents are around $1,200, and they can be pushed easily to $1,400. Current owner is came to me. We did our inspections about a week and a half ago. And she said, hey, I've got a couple leases renewing, but I wasn't going to push the rents too much. It's up to you, do you want to push the rents? But I'm thinking, okay, you got these $1,200 a month rents, and what does the market look like right now? It may take a little longer to find that right tenant. It's better you lose 1 month of rent, there goes your increase for the next year. So I think it's better to play the long game and be smart about keeping a good paying tenant. And rent increases are not always linear. You could go 5 years and not increase the rents at one property, and then all of a sudden, you're going $50 a month, when the time's right. So that's the only downside sometimes with these deal analyzers is, maybe just for me and my own little small sample size in my own little world, it's never just been, hey, it's 5% a year and just goes up and up. There might be years where you're like, all right, we're at the top of the market and we're plateauing for another 5 years. And then all of a sudden you jump back up. And over a 10, 20 year period, you've gotten the averages you've wanted, but it just, kind of comes and goes.
Yeah. No, for sure. And the other thing too, is that, when you're renting now, you have someone that's already paying, right? But when you're renting now, you can do all the checks on them. You don't know that they're going to be paying month 2, month 5, month 13. You know what I mean? Yeah. So what happens if they stop paying after month 5? And now you've got someone sitting there for God knows how long now.
Exactly.
So that's another roll of the dice, which I would not want to be doing with my money, or definitely not with investors' money on the line. But so what do you think are the main factors that have contributed to your success, Jason?
Well, I think having a great partner, my wife and I built a business together. There's been a few deals where we've looked at that, they could bury you, right? They become, whether it's a money pit or it's just, I was really excited looking at a deal, and we look at each other and she's like, we're not buying this. Like, and I joke around, that, hey, she would have left me if we did the deal. Now that's not true, but it's she hates when I say that, but it's like having somebody that can tell you, hey, you know what, this maybe is a wrong, not the, it doesn't fit our criteria, or it's going to be, it's just not going to, why are we really wanting to do this deal? So, that's been, just having a great wife, who's also my business partner, that's been, great for the success. But I think that just always having this desire to continue to learn and grow. So we've grown from say a unit count and an income standpoint, but also growing just from hey, how do I keep honing our process? How do we get better? And I think that desire to try to always be better than we were the day before, that's really the biggest thing, because, this business will knock you down at times. Whether it's COVID and you have to halt distributions, whether it's, A bunch of tenants trash your building and there goes your cash flow for a year. Whatever the case is, there's going to be a lot of things that can derail you, that can kind of kick you in the teeth a little bit. But so I think it's just honestly, it's as simple as keeping a positive attitude, and wanting to continue to learn and surrounding yourself with good people, joining masterminds, reading everything you can. Now you can overdo that because you still have to live your life and still have to, get out there and make things happen. But I just think that, just kind of keeping that positive attitude and taking a long view of things, like, hey, maybe you have a challenge with a property today, that's not, or even employees, that shouldn't define you for the life of your investment career. It can be a short-term challenge. And I just think really taking that long view of things is crucial, because, any business is going to have setbacks and challenges. So it's how you deal with them and how you respond, that's going to make all the difference.
Yeah, for sure. So you're a coach and a speaker. What are common mistakes you see investors make? And then we'll close it up here.
Sure. I think one of the biggest things, is people sometimes focus on the wrong thing. I see it a lot with syndication and multifamily, that, you buy the latest coaching package from whatever guru is selling them. And then there's a ton of great content out there, no doubt, but it's, hey, I want to buy 1,000 units this year. And not that that's a bad goal. Like that's a fine goal, but it's like, what do you really want? And I think the biggest mistake is not having clearly defined goals. If you want to be able to say, hey, I have 1,000 units so I can get on stage and brag at a live event, that's great. But if you're only like 0.5% owner of those 1,000 units, your cash flow is going to be less than a guy or gal that has just a handful of duplexes. So really, I think it's, do you want freedom, cash flow, and really define those goals, and not really make it about the unit count. I mean, the unit count is a useful metric, because if you have a dollar amount tied to each door, but I think people can sometimes lose sight of the fact of what they really want in this business. And they might just mastermind themselves to death. I mean, they could be on calls every day, every week, building connections and networking, but is that the highest and best use of your time? Is that really what you're aiming for? And for some people it is. I mean, there's nothing wrong with it. It's just, but I see a lot of people kind of go down a different path than what they really want, which might be freedom, might be the cash flow. And what's important to you and me from a dollar standpoint is totally different from somebody else. Somebody might say, hey, I just need a few $1,000s a month of cash flow I can live on, I can live very cheaply. And somebody might say, hey, I need tens of thousands, hundreds, whatever it is. It's all your income. It's all relative to what you want and how you're going to spend it. So.
Yeah, the doors is not it's not an accurate way of, I think, assessing your success in the business. I think it's more of figuring out kind of I talk to people, and it's like, set up your 15, your 10, your 5-year goals, and then and then work that into weekly goals and figure out what you have to do every week, and that's it. I mean, people are closing deals all around you just like you, and you feel bad about it if you start at the same place and you feel that you're behind them. But I mean, you have criteria and you have a strategy. And I always kind of laugh a little bit to myself if it's someone that's a little newer, especially where we are in the market cycle. And you and I have gone through 08 and stuff like that, and I was renting apartments and people were negotiating with me, and you're keeping people in them, and because you didn't know what was going to happen, right? And it's something that, I mean, we had no problems. I didn't lose any properties, no rentals, no commercial properties during that time. And I don't know, it's so new people, they don't know that. They're not seasoned like that. So it's something too that you have to keep in your mind too, that, listen, this is the plan. This is what works. We'll stay on it. And at some point.
One thing I'd add to that, I mean, is just I guess a big mistake kind of popped in my mind, is just stop comparing yourself to others, right? So everybody starts and they think what they see on Facebook is reality. Oh my gosh, I just, this guy and I started at the same time and he's got 1,000 doors, and they may not be telling the whole story. And they might start, there's this like jealousy factor, or, hey, I'm not doing enough. And it's, I mean, we maybe all of us hopefully know, a lot of us know now, I mean, what you see on social media is not always reality. And a lot of times people have something to sell, or there's another agenda, and that's okay. But I think, like, comparing yourself to others and where you're at is going to steal any joy that you have. They say comparison is the thief of joy. And so I mean, just be comfortable and happy with where you're at in your own journey, and you know, and don't compare it to the next guys, because there's always going to be somebody, you know, more handsome, fitter, you know, wealthier, whatever it is, you know, nicer car, bigger house, doesn't matter, right? Like it's about you and your own journey. So that's just, I guess that's the biggest thing, is just being centered and being comfortable with where you're at, and what's important to you and your family. And don't let it, I mean, maybe use that other stuff as motivation if that's what you want, but don't use it as comparison.
Yeah. Yeah. Progress. The happiest I've been is when I have progress. So
Yeah.
I think it's Tony Robbins, progress equals happiness. And it's a great thing to live by. And you see where you were a year ago, a month ago, 6 months ago. And, you know, if it's financial or if it's something else, I mean, you've made progress, and that's something that you can celebrate. But how can our listeners learn more about you and your businesses?
Sure. They can connect with me on Facebook, LinkedIn, connect on my website, perorealestate.com. You know, and I've got a whole bunch of info in there. But yeah, you can put my email in the show notes too, if you want.
Okay. Yeah, I've got all your links. I'll put them in the podcast and YouTube notes. So thank you so much for being on, Jason, and looking forward to meeting up with you again face-to-face when we can do that.
Same. I can't wait to see you again, my friend.
Talk to you soon.
Yeah, you too.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars Incorporated exclusively.